In today's video, I want to unpack a big idea floating around Washington right now, the 50-year mortgage. On the surface, it sounds helpful. Lower monthly payments, easier to afford a home, but for most people in their 50s and 60s, this isn't a solution, it's a trap. In this video, I'll explain how we got here, how a 50-year loan actually works, and what the big trade-offs look like in real dollars. Before we talk about 50-year mortgages though, it helps to understand how we even ended up with the 30-year mortgage in the first place. If you go back before the 1930s, mortgages in America looked completely different. They were short and frankly pretty brutal. A typical loan might only last 3 to 10 years. During those years, most people were only paying interest and not really touching the amount they actually borrowed. Then at the end of the term, there was a huge balloon payment where the entire remaining balance came due all at once. So imagine this, you make your payments for 10 years, basically just paying the bank straight up interest, and then suddenly they say, okay, now we need the full $10,000 or $20,000 or $50,000 back in one shot. Most normal families simply didn't have that kind of cash sitting around. Then when the Great Depression hit in the 1930s, that structure completely broke. People lost jobs, incomes dropped, and when those balloon payments came due, a huge number of homeowners just couldn't pay them. And as a result, millions of Americans lost their homes and the housing market essentially collapsed. The government had to then step in to stabilize things. So in the 1930s, they created agencies like the FHA and later Fannie Mae and began to standardize a very different kind of mortgage, the 30-year fully amortizing mortgage. So instead of short terms and giant balloon payments, you now had a much longer timeline with payments that included both interest and principal. The idea behind this new structure was pretty simple and very aligned with how most people live their financial lives. First, you'd pay your house off gradually over your working years, not in some massive lump sum at the end of the term. Second, as you made payments, you would slowly build equity. More and more of each payment would actually go toward owning more of your home. And third, by the time you reached retirement, the goal was that you would own your home outright with no mortgage payment at all, which makes retirement much more secure and less stressful. That basic structure is still the system we live with today. Work during your primary earning years, pay down the mortgage, build equity along the way, and ideally hit retirement with a home that's either paid off or very close to it. Now, let's fast forward to what's being talked about today. There's a new idea floating around in DC to extend that standard 30-year mortgage all the way out to 50 years. The way it's being sold to the public sounds very reasonable on the surface. The pitch goes something like this. If we stretch the loan from 30 years to 50 years, we can lower the monthly payment and make housing more affordable for people who are feeling squeezed. In other words, don't change the price of the house, just spread the payments out over a longer period so the monthly number looks smaller. But lower monthly payments are only half the story. What almost never gets talked about in the headlines is what you give up in exchange for that slightly smaller payment. How much extra interest you pay over your lifetime, how long you stay in debt, and what that does to your ability to retire comfortably. So instead of just repeating the talking points, let's actually run through some real numbers together. These are the kinds of numbers you will not see in a headline, but they're exactly what you need to understand before deciding whether a 50-year mortgage is really a good deal or just a very expensive illusion of affordability. Let's make this really simple and walk through an example together. So imagine you're looking at a home that costs $500,000. You put some money down and end up with a loan amount of $450,000. Now we'll compare two scenarios side by side. In the first scenario, you take a traditional 30-year mortgage at 6%. In the second scenario, you take a 50-year mortgage at 6.75%, which is realistic because lenders usually charge a bit more interest when they're tying up their money for a longer period of time. Here's what the monthly payments look like. On the 30-year mortgage, your payment is roughly $2,698 per month. On the 50-year mortgage, your payment is roughly $2,619 per month. So the 50-year loan saves you about $79 a month. Now, $79 a month might sound nice, but let's put that into context. That's basically one dinner out, an extra streaming service, or a tank of gas. It's not going to be a life-changing amount of money, right? It's not going to make that big of a difference. But in exchange for saving that $79 per month, you're agreeing to stay in debt for an extra 20 years. Where this really shows up is in the total interest you pay over the life of the loan. On the 30-year mortgage, over time, you'll pay about $517,000 in interest. On the 50-year mortgage, you'll pay about $1.1 million in interest. Just let that sink in for a second. That's almost $600,000 more in interest for the exact same house, just because you stretch the payments out another 20 years to save $79 per month today. When you look at it that way, it becomes pretty clear. That's not true affordability. That's a very expensive payment plan dressed up to look like a good deal. You're trading short-term comfort for a massive long-term cost, and most people will never see that trade-off unless someone walks them through the math like we're doing right now. Now let's talk about what all of this actually means if you are in your 50s or 60s and thinking about buying, moving, or refinancing. If you're 55 years old and you take out a standard 30-year mortgage, the math is pretty straightforward. That loan would technically run until you're about 85. Now, in reality, a lot of people don't keep that same mortgage for the full 30 years. They might pay it down faster, they might downsize, or they might move and reset the clock entirely. But at least with a 30-year mortgage, there's a reasonable path to being mortgage-free while you're still young enough to really enjoy it. With a 50-year mortgage, the picture changes dramatically, right? You're now talking about carrying a mortgage deep into your 70s and 80s, and for many people, potentially never experiencing a single year of retirement without a mortgage payment. You're essentially signing up to have housing debt for the rest of your life unless you make some very aggressive moves later on. That has some real consequences. First, it means less equity and slower wealth building. With a 30-year mortgage, after 3 decades of payments, the loan is gone. You own the home outright, and your housing cost in retirement drops dramatically. But with a 50-year mortgage, after those same 30 years, you're not done. You still owe hundreds of thousands of dollars. You've turned a period that could have been about building security into a period where you're still digging out of a hole. Second, it means less flexibility in retirement. If you still have a fixed mortgage payment in your 70s, that money has to come from somewhere, right? That's money that can't go towards travel, towards helping kids or your grandkids, hobbies, or rising healthcare costs. It ties up your monthly cash flow at the exact stage of life when most people want more freedom and not less. And third, it contributes to higher home prices overall. When you stretch loans and lower the monthly payment, more people qualify on paper. That increases demand. And when more buyers can bid on the same number of homes, prices get pushed up. The market adjusts to the new payment level. That tends to be great for sellers, builders, banks, and Wall Street because they get higher prices and more interest over time, but it doesn't actually make homes more affordable for buyers. It just makes the debt last longer. So in other words, a 50-year mortgage keeps the housing machine running, but it does it using your future cash flow. You become the fuel that keeps the system going instead of the system working to help you own your home sooner and retire with more control. There's also a psychological side to all of this that I really want you to see, because this is where a lot of people get tripped up. Most people don't think in terms of what will this cost me over my lifetime. They don't sit down and add up 30 or 50 years of payments. Instead, they look at one thing. Can I afford this monthly payment? If the monthly number feels doable, they say yes. If it feels too high, they say no. That's the whole decision filter. Banks, builders, and politicians all understand this. They don't sell you the true cost. They sell you the payment. They talk about only $2,600 a month, or we can get that down under $2,000. Because they know that's how most people make the decision. A 50-year mortgage leans into that mindset even harder. It lets them say, look, the payment is lower, so this must be more affordable, without drawing attention to the fact that you're stretching that payment out over most of your life. In that setup, you're not really buying a home in the traditional sense where you pay it off and own it outright. What you're really buying is a long-term payment plan. You're essentially renting the house from the bank for decades, often right through the years when you should be enjoying the freedom you worked so hard for. So what should you actually take away from all of this? First, the real problem in housing is not that 30 years is somehow too short. The 30-year mortgage was designed so people could realistically pay off a home during their working years and head into retirement with one of their biggest expenses gone. That basic idea still makes sense. The deeper issue today is that we simply don't have enough homes, and the cost of building new ones has gone up. Zoning laws, land costs, labor materials, and inflation all make it harder and more expensive to add new housing. When you don't fix supply, you can play all the games you want with loan terms, but you're not solving the root problem. Stretching debt from 30 years to 50 years doesn't fix any of that. It doesn't magically create more homes or lower construction costs, right? All it really does is hide the affordability problem by making the monthly payment look smaller while quietly pushing a lot more cost onto you over decades. So the key question to ask yourself is not, how do I get the lowest possible monthly payment? That's the question banks and marketers want you to focus on because it's easier to sell. The better questions are, do I want to actually own my home in retirement? Or do I want to be making payments to a bank for the rest of my life? So if you're in your 50s or 60s and you're wondering how a proposal like this might affect your retirement, your cash flow, and your ability to live more without obsessing over money, click the link below the video because that's exactly the kind of thing we can model out together. We plug in your real numbers, look at the trade-offs in plain English, and make sure the decisions you're making today move you toward a retirement where you're enjoying your life. Thanks for watching, and I'll see you in the next one.